Hello. Welcome back to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. My last video had a bit of a bearish tone to it, and I got a lot of feedback from you guys that you wanted to see more on-chain data. Well, today we will scratch that itch. We have a lot of charts to look at. I'll give you a sense of what I'm seeing in the market, what I think is happening on-chain. So get comfortable, we've got some data to look at. If you enjoy my content, make sure to give my video a thumbs up and subscribe to the channel. If you have any friends or family who are looking to learn more about Bitcoin, I encourage you to share these videos with them. Your support means everything to this channel. Without further ado, let's get started. So here's our price chart. It doesn't look quite as scary as it did the other day, and it seems like this morning we've got a bit of a short squeeze going on here. We'll check out some of the derivatives data in a moment and make sure that that's what we're seeing, but my suspicion here is that we've got a bit of a short squeeze, and curiously it has found a top here on my upper trend line, which I drew from the all-time high breakout. So, we've found a bit of upward resistance here on this liquidation event, but it's nice to see some positive price action. There's going to be a lot of people that get really excited about this morning because it's a Tuesday, they're looking for something to talk about, and what do you have but price ripping back up to almost 49,000. But based on what we're seeing here, you see this very concise ranging we've been experiencing. It's very possible, though we have now broken out of the upper bound of this range, that we might just see it come right back down. I can't rule that out. Pull up my drawing tool here just so we can sketch on this. We've had a very clear ranging behavior, so it makes perfect sense that we would come back down. We don't have to. We could just shoot right back out of here. But based on the price action we're seeing here and the fact that we're still in December and there still hasn't been any kind of news catalyst to suddenly make people bullish, it stands to reason that we'll have similar action in the coming days. I could be wrong about that, but I'm being reasonable. However, seeing a short squeeze is good. We want to squeeze shorts out of the market. And there's a reason why I thought this was a short squeeze. When I woke up this morning, I checked the Kingfisher Twitter, and this is one of those sites that provides liquidation levels for people trading in perpetual futures. And they posted this chart this morning. And the curious thing about it is it shows a bunch of people with stops set just under 49,000. This dotted green line is where price was at the time the picture was taken. And the waves on each side, the blue are people with longs with stops below current price. And the yellows are shorts with people with stops above the current price. So you can expect that if price moves and touches either one of these bounds, that people in these groups will start getting flushed. They'll start having their positions automatically closed. So when we see this big wall here of shorts right under 49K, then we come over here and we see this push. It's very possible that these folks in here are the ones getting squeezed from this Kingfisher chart. So let's go check out the derivatives dash and see if it corroborates this. Here's our well-worn derivatives dashboard. So what we've seen in the last few days, I've got both futures open interest and perpetual futures open interest here together. So OI at the top has the entire market, and then perpetual down here below is just the side of the market that has the continuous contracts. And if you look on the BTC denominated side, which is here on the right, the left is in USD. You see on the BTC side, these have been increasing in recent days. Even if you look at it in USD terms, you can see it has been rising while price has been going down. And one thing we know about the USD denomination of open interest is that it is responsive to price. So when price goes up, the USD value of open contracts and futures goes up by its nature, by the way we calculate it. So when you see price weakness while the USD version of open interest is rising, that indicates a large amount of contracts being opened. And if we see in the BTC denomination over here, it's quite a jump. This is a jump of about 8 or 9% by my last calculation. So not insignificant. And if we zoom back out, we can see it is a pretty high level. It's back up to levels that we've seen provide trouble spots in the past. Now, as the futures market grows and its baseline activity continues to rise, we will keep threatening these previous high levels of open interest. We may reach a point where 250,000 Bitcoin in perpetual futures isn't a scary total. But so far, historically, this has been a pretty high level and we're creeping up towards that now. So it's something to keep in mind in the coming days. If we come down and look at the funding rate, note how it stayed pretty flat as we've been recovering from the liquidation the last couple of weeks, ever since December 4th. Funding was pretty much flat with a couple of dips down into negative territory. And just in the last day, we've seen it jump. This is shown hourly, so we get a lot more fluctuation. And we can see in the last few hours that funding has jumped up to 0.01% after being a little bit low. And when I see this kind of a jump here, in conjunction with seeing this big liquidation map and the people sitting right above current price, and then seeing this manifested in a jump in the price action, it leads me to believe that the reason funding is rising here is because some of these shorts are getting closed out. And if we see on the short liquidations on the right hand here, these are people who bet on price to go down and they were wrong. So their positions were closed. And as price is jumping here in the last couple of hours, there are some short liquidations manifesting on this chart. Could these traders here be members of this yellow group? Very likely. And when we see people with a short bias closed out, and if long traders still have their positions open, then it's natural to see the funding rate tick towards the positive, because some of those positions that were pulling the funding rate back down into its neutral territory are gone. So that gravity is now being removed and we have more longs on the market. So we see a rise in funding. It's still a low funding rate. If I zoom out, you can see it's quite low, but it's been rising. So the trend, the recent trend, is what we will continue to watch. But curiously, if I look over just at pure volume for futures, it's been a bit muted. Just in the last, few weeks, ever since we had that big event, futures volume has been very quiet, and in fact is the second lowest it has been since we were at the summer bottom in late July. So there's not a ton of volume in futures, but we can see there's still some activity going on and some positions being closed out. One thing I want to look at related to derivatives are a couple of charts I've produced that show the makeup of margin within futures. So we've talked a bit on this channel before about how there are two different ways to collateralize your futures position. You can collateralize it with paper, with cash or cash equivalents like stable coins, or you can collateralize it with Bitcoin itself. And collateralizing with Bitcoin produces more volatility. You're collateralizing your position with the asset you're betting on. So when price goes against you to the downside, you can have an extremely short leash before you get liquidated. Conversely, if you are a short trader who collateralizes with Bitcoin, well, your trade position could be going against you while price goes up, but your collateral is growing. So you get this dual volatility when you collateralize with Bitcoin, where when you collateralize with paper, you have more of a stable asset backing your position, which can help to the long side. And I like to look at the makeup of margin to get an idea of where activity is moving around in the market. So what we're looking at on this chart here is the breakup of BTC Leverage. And on the bottom of the chart here, all of these lines represent each of the exchanges. And you can see the color legend at the bottom. And so each of these lines is showing you what percentage of the open interest on each of these exchanges makes up the total market open interest of all positions at all exchanges. The observations that I make about the current chart is we can see here on December 4th, price flushed, right? We went over this in a previous video, and I'll leave a link in the description so you can go back and see how we recapped that event. So we saw this liquidation event, and you can see the BTC leverage, the crypto leverage on both Binance and Bybit, which are these two blue lines, absolutely wiped. And we reported at the time that those two exchanges were the two that saw the most damage and the most fallout on December 4th, because they had a lot of long traders with leverage torqued up, and those people got rinsed. So their share of BTC margin and their share of open interest plummeted that day and has been sideways since, hasn't really recovered. And you can see that most of the exchanges here have been flat in the last couple of weeks. Likewise, this orange line at the top is showing the total amount of open interest that is margined with Bitcoin across all these exchanges down here. And you can see that just in the last couple of months, it's been dropping, and it's now below a 50% mark. So only about 44 or 43% of all open interest is margined with Bitcoin. That is good. We like that to happen, because when we get too much crypto margin, it's difficult for sustained rallies because of the compounding volatility that I was talking about. So it's good good to see declining crypto margin generally, and then flat activity from these exchanges, and even a bit of a drawdown from a couple of these others. This is OKX and Deribit here, but generally not a lot of activity. However, if we look at the paper leverage side, okay, this is the converse of this chart. This chart is showing BTC margin as a share of open interest. This is showing paper margin as a share of open interest. I call paper margin anything with cash and cash equivalents. So Tether stablecoin, whatever the exchange uses. Paper leverage as a share of open interest has been growing and is now about 56%, the converse of this. And the observation here is Binance. You see this blue line? This is Binance's paper leverage. And in the last few days, their share of paper leverage has jumped about 4%. That doesn't sound like a lot, but when it's one exchange and it's one side of their offerings, for it to have jumped 4% of the entire market open interest shows significant inflows to that one exchange. And Binance being the largest derivatives exchange by volume and size is very notable. They aren't always the largest in terms of paper margin. Often they lose that title to FTX and CME, which are the gray and yellow lines here at the top. Again, here's the legend at the bottom. And you can see that CME and FTX usually have a little bit more paper leverage than Binance has. Binance is usually third, and it still is third, but it has recovered a lot of the ground it gave up in the last few days. And this is very notable. This is something worth keeping an eye on. And we can see as this has been jumping, paper margin has been jumping as a percent of open interest. You see this? It jumped from 53% to over 56%. And all of this came from Binance. Look at the other exchanges. They're all flat. It's just Binance. So something to keep in mind as we move forward, that Binance appears to be torquing up. And what we do know is that some of the Chinese exchanges like Huobi and OKX and some of the others have been shedding users as China shuts down transactions inside of its borders. So many of those users could be moving to Binance. We could see this increase representing a migration of traders. It's hard to say exactly, and that doesn't really matter for what the outcome will be, just providing you context and giving you things to think about. So here is our coin destruction dashboard, and there's a couple of things I want to point out here. So we've looked at this a lot, and it's helped us to get an idea of the amount of churn going on in the supply as we've pulled back from the all-time highs. So the net realized P&L is the dollar outcome of all spending each day on chain, both the losses and the profit taking. See all the profit taking here at the all-time highs, consistent profit taking, and then in the pullback, we start spiking down and realizing losses. And this big dip here is the December 4th liquidation. But in the last few days, the loss realization activity has slowed down considerably, and it's starting to narrow and tighten around the break-even mark as price is also tightening down around the lower end of its range. So we're seeing a bullish divergence here where price is tightening and going sideways, and loss realization is slowing down, as well as profit taking. We're seeing a tapering of activity from both sides. And when I start to see activity like this, where it looks like decision making is reaching its exhaustion point, people who want to sell have gotten a chance to sell, people who want to take profit have gotten that opportunity, and eventually everyone who wanted to make a decision has done so. Those moments are extremely susceptible to any kind of catalyst because it almost creates a vacuum, right? We've got a lot of interest when we move into a new price zone. A bunch of people want to make a decision, want to take action, want to transact in some way. Once we hang out in an area for a period of time, eventually the line thins out. Activity wanes and something usually happens to drive price in a direction. So we're seeing this tapering of loss and profit realization. We're seeing a steady decline in the realized profits, which is the trend we've been watching since the top. And the slowdown of realized losses is manifesting itself. A couple of videos ago, I talked about how we thought we were seeing a slowdown in realized losses, but because it was a 7-day median, it was a bit slow to react. Well, we can now see that that theory was true. We are seeing a slowdown of realized losses. There will be some loss realization because price is still negative and sideways. But the fact that the pace of loss realization has slowed down is a positive. We can also see the spending ratio of short-term holders slowing down as well, slowing its loss realization. And when this starts to flatten out, I start to feel that the market is nearing a point where a direction will need to be established. We can't go sideways forever in this $3,000 or $4,000 range. Something will happen that pushes us out to the upside or to the downside, and we'll start this whole process over again. We'll check in with our long-term holders. So we were expecting, as price made new highs, for long-term holders to start distributing and spending their coins to younger hands. That's what they always do when we make new highs. But the distribution of this group has been very controlled. And we've noted that while they did spend some of their supply, largely they've been standing on the sidelines. And their amount of supply has been relatively flat in the last few days. They're not really playing a huge role in what's going on here. You can even see in the net position change metric, which shows the rolling 30-day change of this blue line, even that is starting to smooth out after accelerating after the original all-time high breakouts. Accelerated and is now slowed down their distribution. So they are even seeing less reason to transact here, although many of them sit in healthy profit. Most long-term holders are at 2.5 times or better profit ratios, yet we're not seeing them spend and we're not seeing profit realization. So if these long-term holders are not really distributing coins the way that we would expect them to, but we saw all this loss realization and all of this churning of supply, and we saw the amount of entities in profit plummet all the way back down to 75%, which is the amount of people in profit we had at 29,000 in late July. For all of these things to have happened must mean that the majority of coin activity occurring on chain is coming from shorter term investors. So let's unpack that just a little bit. Here's our realized cap HODL waves. It's been several episodes since we talked about this at length, and I'll leave a link in the description below where you can go back and see the first time we talked about this chart, and I broke down in detail how to interpret it. But we'll do a quick refresher here. Basically, we're looking at the distribution of all coin supply by their age and their weighting in the realized cap. So they're weighting in terms of dollar value. By looking at the supply this way, it helps to emphasize recent spending. When a coin is spent, its lifespan resets to 0 and it joins the bottom group, the hotter colors, which are the youngest groups down here at 24 hours, and then it ages to being a 1 day, 1 week coin, and then it ages into being 1 week, 1 month, and all the way up. The top group that we're looking at right now is 6 to 12 months, and I've taken out anything older than 1 year because I want to focus on the last year of coins. There's a couple of observations here that are important to point out, I feel. The first one is this very top group. You see this light yellow? This is the 6 to 12 month band. Note how the top of the group is pretty much horizontal, which implies to us that the supply moving right now is relatively contained within these groups that comprise the last year of coin activity. There aren't a whole lot of coins falling out of these older senior groups down in here in spending. So we've got a flat top to the 6 to 12 month group, and we have a belling out of the bottom of the 6 to 12 month group. This is showing coin maturation. As coins are sitting here and aging, they're moving up into the 1 week to 1 month group, then they age up into the 1 month to 3 month group, which you can see the belling out here, and then it bells here into the 3 to 6 month group, and then ultimately into the 6 to 12. So you can see the swelling here of this pocket of coins maturing across these age groups. And many of these coins now here in the 6 to 12 month group were purchased back during the bull run and have now been sat on and matured. That's the first major observation here. The second observation is this recent spending. Do you see the influx of warmer colors here? This is showing coins having their lifespans reset to 0. So where did these coins come from? Well, we established that the amount of coins coming out of older groups is limited at best. But what we can see on the chart here is that the 3 to 6 month group and the 1 to 3 month group both belled out and showed maturity in the summer months, but recently have been compressing both from the bottom and from the top. So what we're seeing now is spending out of these groups. Some of it is maturation, shown by the belling out of the largest group at the top. But when we see compression from the top and from the bottom of this 3 to 6 month group, and to a lesser degree, the 1 to 3 month group underneath it, we see this compression right here. That's showing coins spending out of these groups. So coins 1 to 6 months old were spent into the top, into the all-time high breakout. So basically, coins from October back to late May, this range right here, were spent into the all-time high, almost like a swing trade. And these coins did not get held long enough to properly mature into long-term holder supply and remain there. It's possible that some of the coins that moved into the 3 to 6 month group came out of long-term holder supply, because the cutoff for long-term holder supply is 5 months, 155 days. There's a bit of a smoothing function that makes it not exactly 155, but broadly it's about 5 months. But the cutoff for this group here is 6 months. So a few long-term holders ended up in here, and some of them spent, as we can see here on this distribution. So the kind of behavior we're looking at here, after we have noted that long-term holders have not really distributed much coin and in fact have been slowing down recently, but we also know that there was a considerable amount of loss realization and coins churning around at the top, evident by this quick change in the percent of entities in profit, signifying that a bunch of coin are owned from up here that now sit underwater. My conclusion is that those coins predominantly came from purchases in the summer and into October. They were medium-term investors, swing trading coins from the summer lows and selling them at the all-time high. So I find this dynamic pretty interesting. One of the reasons that I've been hesitant to call the bottom being in and to say I think we're going up from here is because I've been surprised at how much price has pulled back from the all-time high. I didn't expect it to pull back as far as it did, and I was suspecting that we might see a few hands that have been holding since earlier in the year or even previous get nervous and maybe try to lighten their bags and de-risk into price weakness. Well, we haven't seen that behavior. We've seen long-term holders with very minimal distribution, and it seems that the majority of coin activity is happening with these medium-term holders, these short-term hands that don't really sit on their coins for more than 4 or 5 months before they spend them again. Just to kind of emphasize my point about the long-term holders, this is showing you the 7-day rate of change of long-term holder supply. When you see positive values, when this thing is spiking up, it's showing you that long-term holders are absorbing supply, that coin maturation is occurring. When you see negative values, spikes downward, long-term holders are spending. Those coins are becoming young and being spent to new hands. In previous bull markets, the rate of distribution, the rate of spending by long-term holders has been well over 2% of their supply. 2% is this dotted red line. If you look at every previous bull run, they have distributed at least 2% of their supply or more. And they've done so as well in mid-cycle distribution events. There's several moments where they have touched this 2% line. You see this? Well, up here in this corner is the recent distribution from long-term holders as we broke the all-time high in October and November. They peaked at 0.7% of distribution. That is very minimal. That's very small. And, the first thing I thought was, oh, well, maybe it's just because price is higher, right? They don't have to spend as much of their supply. Well, that's not exactly true. Price is very close to where it was at the beginning of the year when long-term holders were spending over 2% of their supply on a rolling 7-day basis. So that argument doesn't fly with me. What it looks like is that long-term holders are confident and unshaken by price weakness. They're not ready to sell their bags here. There is still a culture of HODLing and a desire to wait. And seeing their reticence to distribute, to me, it speaks to a sophistication by long-term holders. And it also really helps to emphasize how much accumulation is still occurring on chain, even despite everything we've been through this year. This chart here really emphasizes that point. So this chart is based on Liveliness. Liveliness is a ratio between all coin days ever destroyed and all coin days ever created. We've talked about coin days before on this channel. Every day, every unit of Bitcoin that sits dormant accrues a single coin day. Whenever a unit of BTC is spent, every day that it has acquired since the last time it moved gets destroyed in an instant. And we use those activities as a way of measuring spending and measuring accumulation and maturity. When liveliness is rising, many coin days are being destroyed. Those are periods of high spending and high volume, particularly from older coins that have a lot of days accrued to them, being destroyed at once. Moments where liveliness is rising quickly can be shown here in these big blue bands. These are periods where the 30-day average of liveliness far exceeded the yearly average of liveliness. Periods of orange on this chart are when the monthly average of liveliness dips below the yearly trend. These moments are usually periods of accumulation. They tend to follow heavy spending, and moments of high activity in markets are generally followed by periods of quiet. There's a lot of fervor, and then it takes time for emotions to settle, for interest to reset, and for capital to be accrued again. And if you look at the trend of this liveliness ribbon that we're looking at together, there are big blue swaths during bull markets, and then orange periods during bear markets, during accumulation. And this ribbon, this liveliness ribbon, which compares the 30-day and 365-day averages of liveliness, has only printed 5 times in Bitcoin's history. And each of those times previous were in the depths of bear market accumulation periods. It's important to note that liveliness is not directly connected to price. Price is what causes spending, and spending is represented by liveliness. But when you see a liveliness ribbon print, that is not telling you that price is going down. What it's telling you is that spending is below its yearly average. And by the nature of the way the liveliness ratio is constructed, if spending is below its yearly average, then conversely, accumulation is rising, because the denominator for liveliness is based on coin accumulation, on coin days accruing. Now that I've explained how the liveliness ribbon works, look over here. We have a print of the liveliness ribbon at the all-time highs. This has literally never happened before. Every instance of liveliness printing on this ribbon has occurred mid-cycle, far away from all-time highs. The closest we ever got to an all-time high was last year in November of 2020, just before we broke the all-time high. We were still printing on this liveliness ribbon, and it ended just as we broke the all-time high right here. But now, and I'll zoom in a bit more so we can see this more closely, but now we're actually getting a print of the liveliness ribbon just after a double break of the all-time high. Part of this is influenced by the heavy spending a year ago, which helps to set the lower bound of the ribbon, and the fact that we've had such light spending in the months following it. That's helped to bring the 30-day average of liveliness down. So there is a bit of explanation as to why we'd be seeing this print. However, it's still remarkable that we have now broken into all-time highs, seen price discovery and all the drama that comes with it, but the amount of spending that occurred was not enough to prevent us from printing the liveliness ribbon. So the takeaway from this chart and what we're looking at here is that regardless of the spending we're seeing, regardless of the loss realization, we already know that long-term holders did not distribute very heavily as we broke into price discovery. And then seeing that in conjunction with the fact that accumulation is still occurring heavily on chain speaks to a bullish dynamic that still exists underneath the price weakness. So in my last video, I expressed a lot of bearishness. And in fact, we didn't look at too many on-chain data points in my previous video. And it was important for me to express to my viewers that number cannot go up forever. And sometimes number must go down before it goes up. Price must pull back before it moves forward. That kind of dynamic is true in all markets. And when I see things that give me a bearish sense, when I feel that we are in for volatility or uncertainty, I feel compelled to share it with you, regardless of whatever bullish dynamics might be happening on chain underneath. Because we could have heavy accumulation and still have people that hold Bitcoin looking to take profits that push the price down. It's important to understand those things. On-chain can be showing a number of bullish factors, which represent and manifest themselves on a macro scale, on a zoomed standout level. But day to day, week to week, price itself is driven by technical factors, derivatives markets, order books, things like that. So yes, on-chain is very important, and it will continue to be the foundation of all of our analysis. But there are times when the spot market and the derivatives market are driving the action. And in my last video, I felt that spot weakness was more important to focus on than the on-chain data. So I wanted to explain that that was my perspective, and also have you understand that as we've looked at today, there are still a number of things going on-chain to be confident about, to feel good about. We're seeing a tapering of loss realization. We are seeing continued accumulation by hodlers, and it looks like the spending that we saw recently predominantly came out of groups that bought their coins in the last few months, basically since the summer, not from long-term holders broadly. As we come into the next few days, I'll be watching the jump in Binance open interest particularly, and the larger jump in OI market-wide. As we discussed, the funding rate has risen recently, and I believe it's partially in part because of some of these short liquidations we saw this morning. Their positions were closed out, and the longs remain, which helps to rise the funding rate. We are getting close to a point where the amount of OI in the market is a dangerous level, though that isn't a guarantee of volatility. It's something that we need to remember over the coming days. If we were to see immediate price weakness, the first thing to do is to go look at the data. Find out what's causing it before you allow the price itself to drive you to act. So that's what I wanted to go over today. There are a number of things happening all at once, and it's hard to get a clear sense of where I think price is going. But my goal is not to predict price outcomes. My goal is to show you the data, particularly on-chain, and give you a sense of how the market overall is behaving. We're still seeing accumulation. Long-term holders are not spending very much, and a lot of the recent price action seems to be driven by holders of Bitcoin that have bought recently. Some of those short-term holders will mature and become hodlers. Make sure you follow me on Twitter at TXMC Trades. You'll find a lot of my analysis and observations on there. You can also find out about other shows, podcasts, and content that I'm participating in that doesn't make it onto YouTube. With Christmas coming up in a few days, I'm not sure if I'll get a video out. If we don't speak before December 25th, I wish you all a Merry Christmas. I hope you're able to spend time with your families and also find time for yourselves to recharge and get ready for the new year. I hope you're all doing well. Take care of yourselves. Enjoy the Christmas season, and we will chat in a few days. Cheers.